Well, the markets have seen a bumpy start to October, under pressure today after rallying on Friday's blowout jobs report. Joining us now, we want to bring in Jonathan Krinsky. He's BTIG's Managing Director and Chief Market Technician. Jonathan, it's great to have you here. So let's talk about you closely watch the technicals here. And when we see this massive run up in the S&P, your latest note was out titled Running in Place. And I know you're taking a look at the trading range that we've been in here for the S&P 500. So what does that then tell us? What are the critical levels that we need to watch when we're trying to figure out where this momentum trade goes next?
Yeah, so good to be here. We came into October thinking that we would actually have a down October, a red October, partly because we've been up 5 months in a row heading into October. Seasonally speaking, in election years, the volatility and the weakness tends to persist right up through the end of the month. That makes sense given the uncertainty of elections. And, we kind of were bumping up against that resistance level in the S&P, 5750. So we still think that there are decent odds that we finish October down, or at least see some volatility. And that's the other point. Even in election years, when October finishes green, there is almost always some sort of intra-month drawdown. And we did have a little bit early last week, but I think, you probably, we should expect a bit more than what we saw last week. So that's still our base case. But the fact that the bulls did hold the line, that 5670 level was the prior highs back this summer. We held above that. So, until you can get a definitive close below that 5670 level, we think we're kind of probably stuck here. So we still don't see a ton of upside ahead of the election. I think that the uncertainty there will kind of cap things. As you guys have been talking about, there's also the Mideast uncertainty. So we don't see a big breakaway move prior to November. But again, until you can close below that level, it's tough to get any downside momentum going.
But Jonathan, we have big tech. Doesn't that always lift all boats?
It's funny. Big tech has been broadly taking a little bit of a backseat. We've seen, equal weight S&P and some of the other sectors kind of showing some leadership. So, you could argue that's a good thing. The broadening, if you will, it's been acting, the rest of the stocks outside of big tech has been acting better. So ultimately, I think that is a good thing, as long as big tech, doesn't falter too much.
Jonathan, when it comes to small caps, I think that's really been a focus here for so many investors, especially on the back of that 50 basis point cut here from the Fed. Now going forward, though, with future rate cuts, I think very much in question just in terms of the timing of them, the size of what they are going to be. You're closely watching some of that relative strength. What are you seeing there? And I guess could October maybe prove to be a bit different for small caps?
Yeah, the small cap trade has been frustrating for many. They seemingly got everything you would think they would have wanted, in that we got the 50 basis point cut in September, which should have been good for them. And then we have firming economic data, which, you could argue that pulls off the table some future rate cuts. But I think ultimately, small caps would probably rather have a good economy than a bad economy with rate cuts. So I think, the fact that they got that and they still can't, really break out in absolute terms, and certainly in relative terms, they continue to struggle, is a bit concerning. But, it might just be, we need to get through this October period. So, there's nothing, ominous about them. It's more just a bit of a frustration. So I think if we were to get through November and the economic data is still holding up okay, and they still cannot show any upside leadership, that would be, a bit more of a bigger concern. But for right now, it's just more of a frustration for those looking for outperformance from small caps.
Do small caps require a more aggressive rate cutting cycle from the Federal Reserve than Friday's jobs print may have indicated to have more upside heading into year end?
Again, I think if you're asking what they would rather have, significant rate cuts or an improving economic backdrop, I think it's the latter, because as we know, if you have sizable rate cuts and that's into a recession or some sort of hard landing, that's not a good environment for small caps. So that's why, rate cuts with stable economic growth is probably the best setup. And, we'll see how that plays out with the data going forward.
All right. Jonathan Krinsky, BTIG's Managing Director and Chief Market Technician. Thanks so much for joining us. We appreciate it.
Thank you.